Hello, this is Reid. I'm president of Real Assets for Westwood. I'm here to provide a nice update for the June 2024 highlights for the midstream energy infrastructure market. Before I get started, let me just wish all of you a very happy and relaxing summer. Looks like it'll be a good time for everyone, and hopefully you'll enjoy some time with your family. June was actually a really good month for the midstream energy markets, as shown on page 2. For the month, the Alerian Midstream Index was up about 2.9%, very much in line with the Alerian Midstream Select Index, which is a RIC fund index, up 3%. And the MLP segment of the market, which is about 25%, was up about 4.5%. And so that brings the year-to-date numbers up solidly in the high teens to mid to high teen type numbers. Alerian Midstream's up 16.1, Midstream Select is up 18.9. So by any calculation, this is a very solid year. The story is not nearly as good when you look at the broad energy market. XLE, the ETF, was down about 1.4% and is up about 10.5, but still respectable showing. Oil services were kind of flattish year to date, up about 2.2%, and the clean energy names kind of brought up the rear, down about 14%. So what we're seeing is a continuation of strong performance from traditional energy and weak performance from the renewable sector, which is largely a function of the higher interest rates as well as the challenged business models those companies face. In terms of commodity price performance, crude oil was up strongly 5.9% and 13.8% year to date. Natural gas was flattish for the month and up about 3.5% year to date. You may recall that natural gas at one point was down about 25%. So it has recovered strongly back to, kind of a up 3% type return year to date. So the way we look at that is commodity prices are supportive of volume growth, and that's good news for the midstream energy asset class. In terms of the three different kinds of breakdowns here, the C Corp average, U.S. C Corps were up 2% in June. The top performer was Cheniere, up 10.8%, followed by Targa. Those are two of our largest holdings across our products. And on the weaker side of things, NextEra Partners, which is really outside of our index, that's a renewable name, down 18, and E-Train was down about 9%. On the MLP side, Genesis, another top holding of our strategies, was up 7.7%, while some of the names we don't own that are small to mid-cap type names, USAC down 7.2 and Sun down 6.6. And then wrapping up, the Canadian average was up 1.9%. The smaller cap companies led the field, up 6.4% for Key, while the larger cap names, Enbridge and TRP, were both down. And that continues the trend that's been playing out this year, we'll talk about on the year-to-date numbers. Moving over to year-to-date, it's been a very strong showing for the C Corps in the U.S. Targa is up 50% year-to-date. DTM is up 32.7, and E-Train, which is being acquired by EQT in the next couple of weeks, we believe, is up 30.8. On the weaker side of things, NextEra Partners down 3.5, which we don't own, and Cheniere is actually lagging this year. That's a terrific LNG export company, only up 3% year-to-date. What's going on there is they're fully contracted year to date, and natural gas prices have been generally down most of the year, and so they don't really have the tailwind that they've seen the last couple of years. On the MLP average, Western Gas is up 42%, Genesis up 26.7, and Energy Transfer up 22.6. So the common denominator, though, those are all three names that we own in significant size across our portfolios. And thankfully, on the weaker side of things, these small cap names, CapL, Sun, and DKL, are all down. We actually don't own those stocks, thankfully. And so those are really kind of non-core MLPs, Sun being a fuel distribution company, as an example. Some of these small cap names, a lot of folks just aren't that interested in owning, and the stocks are lagging. On the Canadian side, the average stock is up 13.1. What really stands out is two of the small to mid-cap names, Key and Gibson, are up about 20%, whereas the two largest companies, TRP only up 3.9 and Enbridge is only up 5.5. So that continues the trend we've seen all year where the two market leaders in Canada are significantly underperforming. Thankfully, we're underweight those names. What really causes concern there for us and other investors is that they have high leverage, about 5 times debt to EBITDA. They're not really free cash flow positive, and yet they're still growing their dividend. And so that really doesn't make a lot of sense to a lot of investors. They're really two of the midstream companies that are not operating with the new playbook to return free cash flow to shareholders. They're kind of running the old midstream model from 5 or 10 years ago, and their stocks are basically suffering because of their strategy. In terms of our outlook for 2Q reporting starting this week, Kinder Morgan reporting Wednesday after the close, we're expecting some of the volumes to rebound in 2Q that were shut in due to weather-related issues in the first quarter. So kind of a bounce back from some weather shut-ins that we saw in 1Q. Generally speaking, most of the company's balance sheets are repaired, meaning they're in strong financial shape and they're able to raise dividends and buy back shares. Investors are really keen to understand, what are the companies going to do in terms of dividend increases and share buybacks going forward, and that'll be the big topic on 2Q. As I mentioned, Enbridge and TransCanada are really not in that boat. They're basically trying to pay down debt still, which most companies have largely accomplished and are moving forward with free cash flow strategies to return cash to investors, which is clearly what they want. And wrapping up, we think that growth will be stronger in 2Q, particularly in oil supply and natural gas liquid basins. And we're seeing a nice amount of demand for natural gas to help power AI data center growth that has certainly become a pretty popular topic here the last couple months. And so on average, and wrapping up, we think companies will update guidance at this mid-year point, and there'll be a general bias toward higher guidance given that crude oil prices are in the low 80s and natural gas prices have stabilized up about 3%. So looks like a pretty good quarter coming up. And we'll look forward to giving you an update in July when many of the companies have reported earnings. Thank you so much.